it so challenging for me to get financed by a VC? Well, every time you speak to a VC, they're going to be looking at you through the lens of risk and return. And we established that history, traction, that sort of thing is a factor that contributes to the risk of your company being extremely high. So you might say to yourself, okay, well, I'm just starting out. Like this is a chicken and egg scenario. How can I build traction, build revenue, build data and history to prove to a VC that my company, my business model, my idea is not as risky as they think? Because I need the money in order to do that. Well, there's other ways around that you could show that you're building traction, improving your business model, other than just generating revenue, which we'll get into. But when a VC is evaluating an investment opportunity and you're pitching the VC, you might be thinking, okay, I'm going to talk about how this company is going to be worth $1 billion, and I'm going to be talking about how great my idea is and how I'm helping the world. All of that stuff is great, but again, if you're not hitting on these three elements, then they're not going to invest in your company. So what are the three elements? Can your business survive in the short term? Number one. Number two, can it grow exponentially in the medium term? And then number three, even if you have number one and number two sorted out, you're growing your business, you're killing it. If you don't have number three, the VC is not doing their job. And that is there an exit opportunity? So you heard that I'm on the investment committee of an Ontario government-backed fund that has about $350 million in assets under management. And there's actually an entrepreneur in the room who was pitching me while I was on this panel, I think about a month ago. And so we received a number of pitches. I'm not singling this entrepreneur out, but after the entrepreneurs left the room, the CEO and the CFO of this government fund went around the room to the investment committee members and asked us what we thought of the deal. And then they got to me. And I said, okay, well, these companies seem great, but let's look at the term sheet that they're putting in front of us. Like, what are they offering exactly? They want us to invest in this thing called a SAFE, a simple agreement for future equity. So they want us to give money to this entrepreneur so we can potentially have that piece of paper convert into equity or shares in the business at some point when there's a triggering event. And the triggering event would be the company's next financing round, next equity financing round.